So the question that we're doing says that Huge Limited is contemplating the acquisition of Tiny Limited. Huge Limited is contemplating the acquisition of Tiny Limited. Huge Limited is contemplating the acquisition of Tiny Limited. Huge Limited is contemplating the acquisition of Tiny Limited, full stop. The following information relates to the two companies. The following information relates to the two companies. Huge Limited is contemplating the acquisition of Tiny Limited, full stop. The following information relates to the two companies. Then the information looks like this. So we have earnings to ordinary shares. Earnings to ordinary, just like that. We have 6.678. Then we have 1.162. Number of ordinary shares. Have 1.26. Then we have 200,000. We have MPS and EPS. MPS and EPS, 80, and then 5.3. Here we have 12 and 30. These are shillings. The offer price of Huge Limited is Kenya shillings 56. That is the offer price. Required. Determine the post-acquisition EPS for the predator and the target. Determine the post-acquisition EPS. Determine the post-acquisition EPS for the predator and the target. So when they're talking about this, what you need to understand is that at the post-acquisition, we are having two companies that are going to merge. We are having two companies that are going to merge. So after merging, then now we have post-acquisition. So post-acquisition is after the merger. Even though we are going to take over directors, the shares of the Tiny Limited, after acquisition, we only have one company remaining. Even though we are going to take the shares of Tiny Limited on this side, the directors still remain. Bado wako. Wamekuja hapa lakini they are alive. Tunaelewana? Yes, the directors here or the shareholders here will come and buy shares at Huge Limited because Huge Limited is going to buy this company. They are still going to remain alive. And the amount of shares they invested here, they were getting some income on that investment. They still expect to get income even though the shares have been transferred. And to them, though the exchange ratio has been given, they still believe that the number of shares that they were having initially still remains. So they still remain with the number of shares that they were having initially. In other words, kama mtu alikuwa na 1000 shares, hata kama zimeletwa huku, yeye bado anaamini ako na 1000 shares. It is only that when they are now moved here, they have been reduced. Lakini ile shares ali-invest, the shares that he invested here were 1000. So hata kama zimeletwa huku zikiwa 500 shares, yeye anaona that his 1000 shares should still give him something. The conversion is in the book value, but in his record, he believes that he invested 1000 shares. So the examiner is able to ask you the post-acquisition EPS for the predator and then target. So if he talked about the predator, that is the post-acquisition here after acquisition. When he talks about the target after acquisition, he's trying to ask you, according to the Tiny Limited's shareholders' understanding, the investors here, what do they understand according to them with the shares that they were having before? Determine the non-diluting offer price. That is question number 2. Determine the non-diluting offer price. Determine the non-diluting offer price. That is question number 2 that we're going to solve. Then question number 3, which is the last one, under this, or you call it Roman 3. The question says that suppose the Huge Limited, and I'm hoping that you're writing, suppose that Huge Limited, pardon, part 2. Part 2 says that determine the non-diluting offer price. Na hiyo nyinyi ndio mtafanya, hiyo ni rahisi. Determine the non-diluting offer price. Ruth, hiyo unaweza fanya, si ndio? Today I'm not seeing Winnie, I'm not seeing Florence, I'm not seeing Waziri. I'm not seeing Leah. Leah sijui alibaki wapi. She has been missing for a while. I'm happy to see Rachel today. Rachel, kindly get the videos for the classes that you have missed in this topic. Today is the last one. So the last question says that suppose the Huge Limited was to offer 12% of the 100 per value debenture, of the 100 shillings per value. So you say, suppose the Huge Limited was to offer 12% of 100 shillings per value debenture for every 40 shares of Tiny Limited. For every 40 shares of Tiny Limited, determine the post-acquisition EPS, determine the post-acquisition EPS, assuming the tax rate of 30%. Let me read that again. Suppose the Huge Limited was to offer 12% of 100 shillings per value debenture, 100 shillings per value. Debenture are loans. So what we are saying here, ndio ukiandika uelewe, is that in the first case, we are talking about share-to-share exchange. Tuko pamoja? Yes, like the one that we were doing yesterday, they were share-to-share, you exchange share and share. But in case they have decided that instead of giving you shares, you buy shares here, no. You are going to come, but you come like a debt holder. Yani your shares that you are having, instead of bringing them as shares on this other side, you are going to come with them as loan. Ni kama sasa umetupea loan, we shall pay. So you are a debt holder. So they are going to exchange the shares that you are having here with loan. And the value of that loan that you're being told is that one debenture, you know, debenture is like a share, it's on a certificate. One debenture certificate is worth 100 shillings. One debenture certificate is worth 100 shillings. So that is the value of one debenture. We don't know how many they are, but we are just told the par value, the value of the loan. We don't know the total value, we just know the value per debenture certificate, just like the way per share. So unaambiwa, instead of coming as the shareholders, you'll come like debt holder. So in case they have agreed like that, that is why they are saying, suppose that Huge Limited was to offer 12%, 100 shillings per value debenture. For every 40 shares that you have, for every 40 share, you are given 100, one debenture with the value of 100 shillings. For every 40 shares of Tiny Limited, for every 40 shares of Tiny Limited. Determine the post-acquisition EPS assuming 30% tax rate. Assuming 30% tax rate. Right? So, where do we start from? Who can try the first question? Determine the post-acquisition EPS for the creditor. Who can try that? What are the steps? Who can try the first step? Let me unmute you. I want to see if you can now get the concept. Post-acquisition EPS, where do we start from?
I think we are going to combine the earnings of both companies. Then we divide by the number of shares of both companies.
Thank you. So you say that post-acquisition EPS you say that the earnings of the first one plus the earnings of the second company will have a number of shares of the first one plus the number of shares of the second one. Is it like that? Are we good to proceed? So Milka is saying it is yes. We can proceed. Okay. So what is the next step? We take the number of shares, our earnings. So we have here these ones. Plus the earning shares are these ones. Plus we are good. Topista, is there any mistake or we proceed? Get me the sum. Somebody is saying that it is not good. No.
Mr. Dennis, I have a question.
So you are saying that you should get shares, okay? Mas is saying that we should multiply by exchange ratio, or yes, share of the target, the predator, okay? Topisa has said that we add, but now shares of the target we multiply with the exchange ratio. Okay, so that means that this one should multiply the exchange ratio. I agree with you. How do we get exchange ratio? According to the information that you have here.
Exchange ratio, we're going to take our offer price by the predator, that is 56.
Offer price?
Then we divide by the market price of the nini of the predator, that is 80. We get 0.1, 0.7, sorry. 56 divided.
Thank you. We are doing well. We are really doing well. Somebody has texted something. So yes, thank you. Topista umeandika Mrs. or Predator. Is it MPS or Mrs.?
Okay, nime correct, it's MPS.
So we are here. So we're going to do that. So that is our ratio. So we multiply this one with 0.7. That is our ratio. That now okay. So get me the summation of this. This one should be able to give us something like that is 0. Here we have 4. Here we have 8. So if I have 78, 40, that is the sum. This one 1400, 140. So 140, if I bring it here, it's going to be Kindly confirm. That is the answer. So, yes, I like what Milka is saying. She's saying that alternatively, we could have taken MPS of the target or lower MPS of the predator. MPS of the target or lower MPS of the predator. It's going to give us the same answer. Was it going to give us the same answer? You see, now we need to have exchange ratio, meaning that that is the ratio at which they have agreed to exchange. So they have agreed at this price. That is why we are taking this price. MPS here was supposed to be 80, not 80. So they had agreed at this price. If they didn't agree on any price, then you can now talk about this one. You can talk about this one. But in this case, they have agreed at a certain price. That price might be the best, it might be the maximum price or not, but as long as they have agreed on that, that is what we are going to use to get our exchange ratio. So thank you. What is next? So what are you getting? Is that the correct answer? Just tell me, what are you getting? Is that what you're getting? I hope that is what you're getting. Adjust the board. Is that what you're getting? So that is our post-acquisition EPS for the predator. How do we get post-acquisition EPS for the target? You take this one, the one that you've gotten when they were together, multiply with the exchange ratio. So that is what we did yesterday. Just take the exchange ratio, multiply that. So we're going to have 5.6. So for target, EPS for post-acquisition, or for target, is equal to 5.6 times the exchange ratio. So for target, what are you getting? Kama ya jana tuli multiply na 0.2, a half. We multiply the half. This one, we multiply na 0.7. Okay, so that is okay. So that is how you need to do it. So first get the one for the huge limited, that is the predator. The answer that you're going to get, multiply with the exchange rate that was used there, the exchange ratio that was used there. That gives you post-acquisition EPS for the target. The next question is to determine the non-diluting offer price. Non-diluting offer price. So that is an element that you need to understand. Ratio. This one is very important. Examiner atakuja na wewe unajua kucalculate hadi hapa. Ukifika kwa target tunashangaa, sasa target nitapata aje? Na target haiko. You know, some students think that now because they have been matched, target is no longer there. So if you are told to get EPS for the target tunashangaa, which target are you talking about? And now we only have one company. Yes, we have one company, but remember the directors in Tiny Limited, they are still alive, and they still remember that they invested some shares in Tiny Limited. Even though they have been converted, they have been reduced, to them they still remember what the value of the shares should be. So they are trying to ask themselves, the 2,000 shares that we had, each should be how much? 200,000, each should be how much? The product that you're getting there. Tuko pamoja? So let's get the analytic offer price. Who is going to lead on that? Who is going to lead us? Guys, let's save time. Hii kitu tumefanya mara mingi na ndio tulianza nayo. We can't be that silent unless I'm not audible.
Mr. Dennis, you are going to take
I'm going to?
you're going to take price earning ratio of the predator times EPS of the target to get the non-diluting offer
Directly,
price.
so we are talking about non-diluting. It is say offer price, yes. Offer price is equal to EPS of target or lower EPS of predator
times MPS of predator.
times MPS of
Predator.
huwezi weka MPS of target here. Ya target ndio tutatafuta. Okay, so you come here. This one alone, this one here is the same as the maximum exchange ratio. This one alone. Tulikubaliana hivyo?
Yes.
Yes. So it is just maximum exchange ratio times the MPS of predator. And the maximum exchange ratio you get like this. So get me the EPS of target we have here. EPS of target is the 3. That is 3 over 5.3 times MPS of predator 80. Hold on. Did I give you the correct thing? So it is oh, they were mixed. I mixed it. I gave you the wrong information. So this one should be 50. Uzuri, we have not used them. And then this one should be 5.3. That is okay. This one should be 5.81. 5.81. We have not used them, so there is no problem. This one is 80. So that's okay. So we have 5.81 all over 5.3 times 8. So that is what we are supposed to be having. Somebody to give you the answer. Getting different answers. How comes? How comes you're getting different answers? Who is right and who is wrong? So it should be 87. Majority are getting 87.7. That's simple. The last part is when you are now converting. We are told that these guys can decide not to exchange in terms of share to share. They can agree and tell them, the shareholders of Tiny Limited, that every share that you have, you will be given one debenture. And that one debenture is equivalent to or is valued at 100 shillings. So let's now see how we can be able to get the value. So what we do, you say that if one debenture is equal to 40 shares, 40 shares. Therefore, how many debentures will we convert with our 200,000 shares in Tiny Limited? It is the shares in Tiny Limited that we are taking over. So how many will give us 200,000 shares? So that will be 200,000 times 1 all over 40. How many debentures are these? 5,000, right? Debentures. Thank you. So if we are, now we know that these are 5,000 debentures. Those are like certificates. And each certificate is 100 shillings. So how much is the value of loan? Debenture is a loan, long-term loan. What is the value of loan? So how much is the value of debenture? So the value of debenture the value of loan that you're taking is now 500 times 100. That is how much? 500,000. That is the kind of loan that you have taken. By accepting these guys to come over, we are going to take a loan worth 500,000. Guys, are we together up to there? Mercy. Tuko pamoja? We are not together. So what I'm saying, Jen, is that we need to ask ourselves, we are told that suppose these guys have agreed to exchange the shares with loan. Loan is debenture. And the value of each loan is 100 shillings. So what do we need to do? We need to know how much loan are they going to commit to themselves. They are not going to convert them into shares. They are not converting or exchanging share to share. No, it is now shares with their loan. Every share that you have, we give you 40. We give you one debenture. Debenture is a loan. So loan is like a certificate. So they agree that for every one loan that you are going to have, or for every share that you have, 40 shares that you have, we are going to give you one debenture. But you can see that we have a total of 200,000 shares. These are shares that we are going to convert. So you say that if one debenture is equal to 40 shares, that is the exit rate. Therefore, how much debentures or how many debentures will be equivalent to 200,000? So it is cross multiplication, this times this over this. We got total of 5,000 debentures. After getting 5,000 debentures, those are just debentures, but there is no value there. Ni kama certificate, how many of them are we going to issue? To make issue total of 5,000. And we have been told that the par value for each is worth 100 shillings. So we are saying that now the value of loan that we are having is $5,000 debentures times 100 to get us 500,000. Now that is the value of loan that we are going to commit ourselves into if we agree on that kind of exchange. So there I'm asking Mercy that are we together, and also Henry. Mercy and Henry, we are together now there. Hiyo ndio examiner analetanga. Huko juu alideal na share to share, which we have seen how it goes. We are able to get post-acquisition EPS. Now you can be able to calculate the premium which we did yesterday. And you know the premium is offer price minus the market price of the target, sindio? Premium is basically the gain. In case sasa wamepewa hii, na they were supposed to be given this, the premium is just the offer price minus this. So that one we have seen. Today we are now converting this. So again, we have seen that there is a total of the value of loan that we are taking is 500,000. Now, in our calculation, the amount that we are supposed to pay to the ordinary shareholders inakuanga hii, sindio? Sindio kweli? This is the amount, the earnings that should go to ordinary shareholders. Now remember, the company will still operate as usual. And even though they are merged, we are going to still have our income that is 6.6 here and 1.1 here together. That one is not affected by the structure or the way we have agreed to exchange the shares. That one does not affect our income. So therefore, in this income, this is the amount that we're supposed to give to ordinary shareholders. But now a new thing comes in that we are not going to have all this together like this. Kuna loan tulichukua inafaa tulipe, alafu sasa balance tunaweza gawana. Tumeelewa kwamba we have made this much plus this. Lakini kuna loan tumecommit. That loan requires you to pay something. You need to pay an expense of that loan. So that is the next thing. So what is the interest that we need to pay on this loan? Because in that interest you need to pay. That is why this one is called earning before interest and tax. So we need to have interest. Now that interest is there, tunaitoa. Kama interest haingekuwa, tunaigawana vile iko. Now that we have interest, we need to pay the debt holders their interest. So before interest and tax, we now need to remove interest and we remain with our money. So what is the interest? So interest on debenture is equal to 500,000 times, who can tell me? 500,000, Ruth ashafika hapo, times 12, thank you, times 12%. So Ruth anasema it is 60,000. That is the interest that we have. Guys, are we together up to there? Now, normally, when you are calculating, what do you normally do? Either unachukua minus interest, or you normally say EBIT plus that interest this one is now what we call tax shield on interest. So you take the EBIT plus tax shield on EBIT on interest. So you need to get, sorry, let me make it for you in a way that you understand. We normally take our EBIT, which we normally have, like in this case, we are having EBIT to be, EBIT is there, now this and this, right? Because it is before interest and tax. So we have it, do you calculate it somewhere? It was total of 7.8, 40. Then we say less interest. Now that we have interest. So we don't treat this one as the total income. You have less interest, which is now 60,000. Tunaelewana? So when you less this, you're going to have 77, 80. You tax this amount. So that is it. Now you tax this. So that is the profit before tax. Then now let's tax. Tax 30% of this is how much? Can someone tell me? Nataka nisonge pole pole ndio uelewe. 30% of that ni ngapi? $23,334,000. So 23, 3. Sawa. 2,334,000. When you less this, unapata ngapi? Six. Get me the answer. Five, four, four. Sorry, 4, 4, 5. That is what we're going to have. So this is what we're going to have. Then what follows is that you add back depreciation. Do we have any depreciation? No depreciation. So that is what we're going to have as after tax. That's earnings after tax. Is the value okay? Can you confirm if it is okay? Okay. So we need to now have earnings after tax. That is the total earnings now. Interest. 5, 4, 4, 6, 0, 0, 0 over, that is the earning after tax, over number of shares. So which number of shares, which number are we using? Which number of shares are we using? Are we using the summation of these two, or are we using one of them? We're using the one for predator. So we're going to have 120. We're using the one for predator because we didn't take up interest of this other one. So get me now the EPS. What is now the EPS? Post acquisition EPS when you're using loan. We need to do one more example before we wind up. Just hold on, make. Since this one has been taxed, ignore the first one. We are supposed to have the new EPS to be equal to earning for the first one, which was supposed to go to ordinary shareholders, plus earning of the second one, minus interest that we are now introducing. But this interest, we don't pay the all of it. We only pay 70%. So we are having 1 minus T all over the shareholders of the first company. Number of shares of the first company. So you know the first one, we are going to double tax it. That one will mean that we are going to double tax it. So our interest we have calculated here to be the earnings was 7. So EPS is equal to 7,840 minus 60 times 0.7. All over 1. Understand this one very well. Understand this one very well. Why we are not going the other way around? Because for us to arrive here, it was already taxed. If we tax again, it's going to be double. Tutachukua pesa mingi, and this EPS will be small amount, 4.2. So you are only supposed to remove the interest element, and that interest you don't pay the all of it. You only pay the interest less tax, which is 30%. So you pay them less that. So you will have that amount. Maybe you can now give me the answer, 7,840 minus, this one is now 42, right? All over 1, 2. So get me the answer for that. We have not taken the shares from Tiny Limited because we didn't take them over. We have used them to get loan. That is why we are ignoring those shares. So you can call it 6.18 sour. So it is 6.189. Remember, if we were to tax it, we are going to pay 4.2. Was it 4.2? Hii ni kidogo compared to this. Kwa sababu part of the money that we are supposed to pay, we have taxed again. So pesa imebaki kidogo ya kugawa hao watu. That is why it is not right to tax it again because it was already taxed huko mbeleni. Let's look at the last sitting question. The last sitting question. I think now the concept is okay. If we do 1 or 2 questions, then we're okay. And we shall move very fast so that we finish on time. This is the question. Your last sitting. This is December 2023. And the question is question number 3. December 2023, question number 3. So let's look at that question if you are familiar with it. Kubwa Limited is considering acquiring Ndogo Limited, a firm in an unrelated line of business. In order to diversify their risk. We said that some of the reasons why we normally acquire is because of diversification. Sawa. Unakumbuka? We say that a company acquires another company in a different field to diversify the risk. But it can also acquire a company in the same field in order to increase the economies of scale. And if it is in the same line of production, but at different level, then they can acquire so that they can do what? They can secure sources of raw materials. Now, this one, we're told that the selected financial data for both firms are provided as below. We have sales, cost, we have operating cost, we have financial cost, we have number of shares issued, we have market. Kubwa Limited is considering financing the acquisition of Ndogo Limited using share for share exchange or share debenture exchange. And we have seen that, right? The corporate tax has been given as 30%, and that is normal. Non-diluting EPS, and then non-diluting maximum exchange ratio, then post-acquisition earning per share, assuming that the offer price is 30 per share, right? Then we are told that the post-acquisition EPS, assuming 100 ordinary shares, are exchanged for 10 units of 10% of 10 units of 50% debentures. Not 1 debenture now, 10 debentures, 10 certificates. So for every 10, and the power value has been given. Thank you so much. Hii sasa ni rahisi. Rachel, hii unaweza toroka nayo sasa, si ndio? So the first thing that you need to do is to know what is the earning after tax. Earning after tax, that is the amount that is attributable to the ordinary shareholders. So earning after tax, first you need to take the figures the way they are, and allow me to do that so that we get the earnings after tax. So we have sales, we have Kubwa, and I'm hoping that you're seeing the board. Yes, you're seeing the board. So we have Kubwa Limited, and then we have Ndogo Limited. Tuko pamoja? Then we are told that the sales are in millions. So we know these figures are millions. Then we have cost of sales, which is given us 30. And then we have 10. Then again, we have operating cost, which is normal. So operating cost is also given as 10 and 5. After that, we are given finance cost. And these ones you are supposed to deduct. So finance cost is given as 5 and 2. Then we have our number of shares. So from here, we can be able to see the profit before tax. Still, that is where we are. Let me share with you again, just in case somebody is doubting the information that I've shared. Hizi ndio tumepewa hivyo. And this is the last question we are doing, and then we are done with this topic. So tuko na hizo. So tumefika hapa, these are all cost kwenda juu, but we have not taxed it. So we need to tax so that we can say, now this amount is attributable to ordinary shareholders, waende wagawane still. So we are going to get this. This one is something like 45. So here is 55, and then here is something like 17. 50 minus 17 here, 33. Yeah? So after that point, now we are saying that now let's tax at 30%. Ndio maana umepewa hiyo tax. So let's tax. Can we tax this? 0.55. Now we have 0.3 times 55, 16.5. So here we have 16.5. And then here, 33, we have 9.9. 9.9. Toa unapata ngapi? 55 minus 16.5. Unapata 38.5. Hii ingine unapata ngapi? 33 minus 9.23.1. Kwa pamoja hapo. Now this is now what we call earnings to ordinary shareholders. Now in the example that we just did, they had gone through the same profits hadi wakafika hapa. That is why it was not wise for us to tax again. Kwa sababu kitambo wafike kwa hii figure, kuna tax imechapa hiyo figure. Kuna tax ishapitishwa hapo. So if we tax it again, that is not fair. That is not fair. So let's now go back and now use this one as our earnings per share. So that we look at things that are familiar. Things that are quite familiar with you. So we have our earnings to ordinary, which is 38.5, and here we have 23.1. Hapo sasa iko sawa. Then other information that we're given is kwamba that number of shared issues, the number of shares are given 10 and 7. Number of shares. We have 10 and 7. What else are we given? We are told that market price, NPS, is given. And NPS is given us 40 and 20. NPS 40 and 20. Tuko sambamba? Tuko sambamba? Ama kuna shida? Rachel, umetulia sana. Are we together? We can get our EPS from here. Sindio? We know we need EPS somewhere. Because for you to get the non-diluting of exit ratio, you need EPS of the target over EPS of the predator. So we need that EPS. So why can't we just calculate our own EPS? EPS is basically earnings over shares, earning per share. So we're going to have, here is 3.85. See, need divide by 8. Alafu hapa tutapata ngapi? 23.1 divided by 7. 33. Hey, imeingia na aje? 33 sharp. Nice. Okay, we still remember that these figures are in millions. Don't forget about that. The figures are in millions. What else do you think you need? I think we are good. We are now good. So let's now answer the first question. The first question says that non-diluting maximum exchange ratio. Determine non-diluting maximum exchange ratio. And this should be EPS of target over EPS of predator. So that should be EPS of target. We have this one 33.3 all over 30, 3.3 all over 3.85. 3.3 all over 3.85. So let me try it. I see what we are having. 3.3 divided by 3.85. That is 0.857. So let me just say 0.86. That's 0.86. So that rate means that it is 0.86 to 1. That means that for every share that we have in Ndogo, Kubwa Limited will give us not even a half. Watatupea 0.86. So if this one was a half, then you'll say that for every share that we are going to have here, huku tutapewa nusu. Lakini sasa tunasema tutapewa 0.86. That is the interpretation. Multiply by the EPS of the predator. Are we looking for the exchange offer price or exchange ratio? What is the question? Are they asking the offer price or exchange ratio? Tukimultiply tutapata price. They are still asking for non-diluting maximum exchange ratio, not maximum offer price. Ukimultiply tu hiyo na EPS, wewe sasa unatafuta offer price. Lakini bado examiner ameuliza tu ratio, not offer price. Are we together, Ruth? Yeah, lazima uelewe examiner ameuliza nini. And that small thing kutoa tu nje, alafu unasema mwalimu, I don't know what happened. I don't know what happened. Hiyo paper haikuwa mbaya. Imeenda access. Sasa, so up to there, that is what the examiner wanted. Okay, for those who are not there yesterday, we said that this one is able to give us the non-diluting offer price. It is the offer price that cannot make you lose the value of your shares, or it is the offer price that does not dilute the shares. You use this one formula, or the other formula is maximum offer price all over NPS of predator. Hawa watu wawili, hawa na hawa, they are the same. They should give us the exchange ratio, which is the maximum or non-diluting. The examiner can use the word maximum offer price, maximum exchange ratio, or non-diluting offer price, non-diluting exchange ratio. They mean the same. So either use this or this. We could not use this one because we don't know the maximum offer price. We have not been given. So we cannot use this. We can only use this one because we can simply get it. We can easily get it. Sorry, we can easily get it. Now, what is the second question? The post-acquisition earning per share, assuming that an offer price of is set at 30. Nilikuambia, if they have given you offer price, tumia hiyo yenye umepewa. Usije kuwa mjanja unatumia hii ati EPS, MPS of this, all over this. Achana na hiyo. Ngojea wakupee figure. Sasa wametupea. So our new exchange ratio, you say that new exchange ratio with that agreement, our new exchange ratio will be the 30, which is the new offer price, or just say offer price, all over MPS of predator, which is the same as 30 all over. FPS of the predator is 40. This one is giving you what? I know 25 is somewhere there, so it is this one divided by 40. 75, 0.75. That is the new exchange ratio with the new offer price that they have agreed on. How ndio wameamua, wamekubaliana hapo. So that is what we are going to have as the new exchange ratio. Now, what was the question asking? Wameuliza aje? Ati the post-acquisition EPS of this, assuming, so we need to get EPS. So we have our exchange ratio. Our EPS, which we say is called post-acquisition, we are saying that post-acquisition EPS. I mean, najua hii Ruth anakumbuka. Inasema that E1 plus E2 all over nose for 1 plus nose for 2 times the ER, which we have already, times the ER, which we have already. So our earnings are here. We can simply have them, that is 38.5 plus 23.1. These two divided by number of shares here 10 plus we have here 7, but T7 we multiply with the 75, 0.75. Tuko pamoja? So that when we come here, add the two, tell me. This one looks like hapa ni 6, hapa ni 1, hapa ni 6. So it is 61, 6, 61.6. So 61.6 all over. This one looks like what? 10 something. Not even 10. 7 times 0.75. 5.2. And multiply, this one is giving you 5.25 plus now this one plus 10. So it is 15.25. 15.25. What do you get as the answer? Okay. We have 4.0, 4.04 and 39. Okay. 4.039. 4.039. Thank you so much. Or 4.4 is also 0.4 is okay. It's okay. That was the first question or the second question. How many marks have you gotten here? So mwenye alifanya hii mitihani alikuwa na bahati. Already ako na 5 and the pass mark is 50. Anatafuta ingine. Ingine ndio hii post acquisition EPS assuming that 100 ordinary shares are exchanged for 10 units of 15 debentures with par value of 10 each. Mbona vile wametunga hiyo swali? Ni rahisi sana. So what you're coming to say is that na hawa walikuwa na bahati. Hawa walikuwa na bahati. So you say that if 10 units or 10 debentures is equal to how many? How many shares? 1,000 ordinary shares is equal to 1,000. It's equal to 1,000 shares. Then, how many debentures will we have in case we decide to convert 7 million shares? So we are having here 7 million. So we're going to have cross multiplication, that is 10 times 7 million all over 1,000. How much or how many debentures do we have? This one goes like that. So we have there 70,000 debentures. Are we together? Now we have the number of debentures, and we are told that the value of each debenture, these are the number of debentures, value of debentures. So we are saying that the value of debentures is equal to total value. Let me call it total value is equal to 70,000 times 100. So tumeambiwa ni 100 each. The power value 100 each. Tumeambiwa ni 100 each. Ndio, that is the value of each debenture. So that is 7 million. Tumerudi kwa 7 million. That is the loan. We have taken a loan of 7 million. Shakubali hivyo. Then now we need to know what is the interest on that loan. The interest rate is given us. The interest rate is given us. Interest rate is given us. They have not said. Are you sure? 15%. Yes, wamesema. Wamesema 15%. 25. 25 ni nini? 25 or 15 bana. Yes, thank you. It's 25, 15. So we are saying that now interest on this. Unaona hiyo procedure vile tunasonga pole pole. Pole pole tu. So we are saying that our interest is equal to 15% of 7 million. What do you get? $105 million. Wait, no. Can divide by 100. Divide by 100% is 1 million. So the answer is 105. 105. Now that is our interest. We are waiting for the second question. Wanauliza aje? The question, what is the question? They wanted the post question EPS. Sasa ni rahisi. So with this post question EPS, is equal to E1 plus E2 all over, no, minus 70% of this. Unaelewa? Or you say minus interest, because already it has been taxed, so minus interest into 1 minus T all over NOS of the first company, NOS of the first company, or this company. So therefore, here we are confidently moving our earnings. We are done the calculation. Now we got to 61.6. So we can say that the post acquisition EPS is equal to 61.6 M all over, or we can now give a full figure. 61.6, 61,600,000 all over. Remember these ones are in millions, so this should not surprise you. Number of shares. So this one minus 1.05 million times 0.7. This one all over 10 million. You don't add this and this, just 10 million. Milk, I hope that's okay. So we are going to have 1050 times 7. This one times 7. That is 75. So this one we're going to have 61,600 minus 735 over 10 million. What do you get? 61,607. Minus by 10 million. 6 point. But still videos for day one, this topic. Uko sawa. Kuchonjo. And that is what they wanted you to do. In fact, you can now call it 6.09. 6.09. 7, okay? This one is 7. Or even 6.1 is okay. So you guys are okay. Thank you so much. And I love it when I see that everybody's following. When I see that everybody's following, I just love that. Now, the last part of the question inasema aje? Question aishi. So we have bagged our 8 marks. The pass mark is 50. Remember, we are only looking for 42. Tumeweka hii na hii na hii kwa mfuko. So we are saying that considering your results, 1 and 2. B2, that was this one. And then B3, advise the best financing plan. The one that can give the highest EPS, that is the best one, because the shareholders only want the earning for each share. So tell me, which one is the highest? Is it with the debt or with the share-to-share exchange? Debt to share exchange, debenture and shares, or share-to-share? Nimesahau, sina hizo figures. Debt iko na high. The other one is worth how much? It was worth how much? Ile ya kwanza tulipata ni ngapi? With the share 404. So you can advise. You say that the management should choose the option for debenture. How do they call it? Unaangalia tu hapa Kisungu, usisumbuke sana. Sisi ni watu wa hesabu, sio Kisungu. So they said that there was an option using share exit or share debenture exchange. So unawaambia that management should use or take the option for share debenture exchange. The share debenture exchange, because it gives the highest EPS. Every share is going to give the highest. So hapo tuko sambamba. Na sasa, I think now we can summarize that later. We can summarize the data by looking at valuation of target companies. So we still have like 10 minutes. I can 15 minutes. Those 15 minutes, I can look at valuation of target company. Now they have a concept that how about the target, which is the best option? So that means that you need to get the shares of the target. So rahisi tu. So the target guys, you see the target, you now look at the interest. Because in the second option, the target people, they don't have earnings from shares. They don't get dividends. Sasa, hapa wanapata interest. And in the first option, at least they could get. So in the first option, you could take exchange ratio was 75, still. Was it 75 exchange ratio? So you take 4.04 times 75. Alafu unaona each of their shares is going to be how much. But now you cannot compare these. These ones are EPS, earning per share. Lakini hii ingine ni interest. So they are different. Huwezi compare mbuzi na kondoo. Itakuwa ngumu kidogo. maybe sasa useme they have how many debentures? If debenture they are having total of interest of this. Hii ukitoa this one ukitoa tax unabaki na ngapi? Let me just try to reason. So ukitoa tax hapa ilikuwa 105. Toa tax unabaki na 357. And how many debentures were they having? How many debentures were there? Yes, we want to look at where they are benefiting more. How many debentures were they having? They are going to have total of interest is going to be interest bado ni pesa. Interest means 735,000. Sindio? Hapa each share is going to be how much? Okay, calculate even each share for ordinary shareholders is going to be 0.75 times 4.04. So they are going to have 3.070503. That is the value of their share. So how much again are they going to have in total? This one is interest in total. How much again are they going to have in total? So take this one times the number of shares. Number of shares were 7 million. So multiply this with 7 million. If each share is going to give a return of 3.03, then multiply with 7 million. They are going to have return of we call it a total earnings of 7 at 21 to 1. I think the option of shares is good because now each share is going to give them this one. Hiyo ndio wanaenda nayo nyumbani and they had 7 million. If you calculate unapata ile. That is what they're going to take home. While the other option is interest. So I can see that the earnings, total earnings is going to be more. So the ordinary shares, the share to share exchange is better for them in totality. Their share did come to Predator as 7. Mi napenda hii. So it means that Milka ameshika rada. Milka ilikuja in terms of less than that. And that is why we have reduced the values. Hata hii value sio value ya Predator. Hii sio ya Predator. We have used this one. This is the value for ndogo. That is why we have multiplied this with this so that we can get their specific EPS. Kwa hivyo tumetumia tu EPS yao ndio tumemultiply na hii. Kama tungechukua 4, then I would say that it is not correct kwa sababu hii 4 ndio value ya hapa. Sasa hii 4 ni after acquisition wakiwa hapa. Lakini sasa I've reduced it back to their equivalent which is now 3 point something. Hiyo ndio nimetumia multiply. Let's look at valuation of target company within the remaining 10 minutes. That is more or less of theory. In this one, they were taking some concept from topic 3 and topic 4, where they are trying to get the value, but they are talking about target company. It was in topic 3 where we are looking at the value of companies, but now you're looking at value of company that has been targeted. How many shares? Their shares still remain at 7 million. 7 million. So 7 times that. So valuation of target company. Here the continuation to bado. But not merging and share and not mergers sasa. Target company. Valuation of target company. So we have methods of valuing the target company. We have methods. The first one is called, and this one we had mentioned, discounted cash flow method. Yeah, continuation. Yes. We are not going to talk about EPS or what. Those ones that we've done. Hapo tumetoka kidogo. There is the last concept where they have taken some part of topic 3, mix na topic 4. So they are looking at valuation, which is in topic 3, but target company, which is topic 4. It is a continuation of topic 4. So we have the first one is called discounted cash flow method. Ukimaliza hizo methods, then we should be done with topic 4. We have P ratio method. P ratio method. We have earning yield. Which we call DY method. Then we have dividend yield method. Dividend yield method is also called DY method. Those are basically that. That should be the end of that. Then if we are done with this, then we are done with topic number 4. Yes, these ones and to tumalize topic 4. So P ratio method, discounted cash flow method, Let's do an example of discounted cash flow. Ikifika tu the next 6 minutes, ikifika tu time sharp, tunafunga hii kazi. We shall continue from there. So let's look at discounted cash flow. So in this method, I want us to look at an example where we have illustration. Where you have time. You also have cash flow of target company. What is basically happening here, Rachel? What is happening is that a company might want to acquire another company, lakini wanashangaa, what is the value of this company that you're about to acquire? How much can we pay? So you have to value it before you pay, before you acquire. That is why we're looking at valuation of the target company. And so the methods number 1 will be the price over earning. That can be P ratio. Another one is the cash flow that you're going to get from the company. So unafanya hesabu. How much can I expect from this company until the end? So that is what we are referring to. So we have the year, we have 1, 2, 3, 4, and then we have cash flows that we expect from this company as that 15. This is 15. Additional information says that the real cost of capital, say additional information. The real cost of capital is 8%. General inflation is 5%. Real cost of capital is 8%. General inflation is 5%. Real cost of capital is 8%. The real cost of capital is 8%. General inflation is 5%. Required. Determine the value of the company using discounted cash flow method. Determine the value of the company using discounted cash flow method. Determine the value of the company using discounted cash flow method. How many minutes? We have 4 minutes to go. It's so sad. We have CF, we have PVFA or PVF. Is it PVF or PVFA? The cash flows are irregular, so we will have PVF. The rate that we've been given, I don't know. We are going to calculate. Then we have PV, present value. So we have year, time. So we have the first year, 2, 3, 4. Which rate do you think we should use? Cash flow are given. Which rate are we using here to discount? Which rate are you using to discount? So, Melka, I don't know where to pardon from. The question is that real cost of capital is 8%. General inflation is 5%. Then the question is, so inflation is given as 5%. Cost of capital is 8%. They are telling you to determine the value of the company using discounted cash flow. Discounted cash flow. Now, I'm now asking you, we've been given the general inflation and the cost of capital. Which one do we use? So whenever you're given the cash flow like this and the examiner is silent, always assume that this one is nominal cash flow. Sawa is not real. Real inamaanisha they have considered inflation. Wametoa inflation. Iko tu uchi bila inflation. Lakini ikiwa hivi, it is raw, iko na inflation ndani yake. Right? Sawa. So unless the examiner tells you that this one is the real cash flow, always assume that all the cash flows have inflation in them. So they are called nominal cash flow. So that is why in the additional information, they're telling you that the real cost of capital is 8%. So they want you to now change it to nominal cost of capital because the cash flow are also nominal. The cash flow is also nominal. So convert the real cash flow and the real cost of capital to nominal. How do you do that? So if the examiner has not told you to calculate discounted cash flow using real, just convert them to nominal. Now find a nominal. So let's look at the formula. You remember this formula where we are saying that 1 plus n is equal to, it is called Fisher's formula, is equal to 1 plus r into 1 plus I, where r is the real, I is the inflation. That is Fisher's formula. It is the one that you use to convert the real cash flow to nominal or nominal to real. Na hiyo tulisoma in topic number 1. Sasa under inflation. So you can now have 1 plus n to be, n is the nominal rate, r is real, I is inflation. So this one is equal to 1 plus 0.0. Real rate, the rate for real is 8 plus 1 plus 0.05, plus 5. So that we have 1.08 times 1.05. So n is equal to whatever the sum of that is, 1.08 times 1.05, the answer minus 1. What do we get there? Ushapata 13%. Thank you so much. You're going to have 13.4%. Now this one is now nominal rate. We are saying that the cash flows are also nominal unless you are told it is not. So the rate that we're using here is 13.4%. If you use 13.4%, you can now get our value. I want you to proceed and now get the value. Discounting factor of year 1, year 2, year 3. Na utafanya zote na upate. Sio 0.881418 or 48. Alafu hii pia tafuta zote, multiply here, it is 8.818. Then you add. That is the value of the company. get discounting factor using that rate for all of them, multiply, get them here, add the total. That is the value of the company. We shall stop there, it is time. Hiyo ingine mnaweza fanya, si ndio? Ruth, ni hivyo. We can do it, eh? You guys can do it. Just getting discounting factor for each mpaka chini hapa, and it is PV, not PVFA, kwa sababu the cash flows are irregular, cash flows are changing, so use PV. Na ukimaliza una add total. In our next class we shall start by looking at the P ratio, then earning yield, then dividend yield. It is a small area that can take roughly 30 minutes or 1 hour. 30 minutes to 40 minutes actually. And then we start a new topic. Or maybe we do another edition in APS if you want. If I say have a good night, not a bad thing. Good night.